Hello everybody, in this video we'll be beginning with the chapter number 22, equities of CMT level 1. Before watching this video, make sure to watch the previous chapters. In case you haven't, then I've linked the playlist in the description box below. So this is a very tiny chapter and we are just basically learning about the basics of equities. So these are the learning objectives. First we'll be learning about what are equity securities and what are the primary data types. The second thing is benefits of equities to investors. When I'm talking about investors, I'm talking about people like you and me who want to invest in the stock of the company, right? So we are investing in the equities. So what are the benefits which we can have? And then the third learning objective is identify the effect of corporate actions on price data. So when the corporate takes actions, what effect does that have on the stock price? That is also something which we'll be learning. And the last learning objectives is classifying sectors, capitalization and other ways to segment. So how can you segment the market? You can segment the market on the basis of sectors. You can segment the equity market on the basis of market capitalization. So there are various methods using which you can segment the market, right? So that is also one thing which we'll be discussing in this chapter. So what are equities? The terms equities and stocks, they have different origins, but they are interchangeable. So people often use the word equity and stocks interchangeably, right? So they both represent an ownership share or portion of the value of a company. So both of them have the same meaning. Both of them represent ownership only. Ownership, right? So both equities and debt have claims on the liquidation value of a company. Now what is the difference between equities and debt? So there are two ways of raising money, raising finance. It can either be through share capital, which is equity, or through debt. Now what is debt? Debt is basically a form of loan, or we can say it is borrowings. Okay. So unlike debt, so if you, just a second, let's first discuss from the book itself, then it will be easy to understand. Okay. So there is no implied guarantees other than sharing in the fortunes of the company, good and bad. Contrast this with debt. So what happens in debt? It carries a promised rate of return. Equities have unlimited upside potential, whereas debt is limited to a stream of defined payments. So when you talk about debt instruments, there is a particular fixed amount or the fixed interest, right, which can be received. But if you're talking about equity or share capital, whatever you're going to receive, the dividends or whatever, it is going to be unlimited. It can be how much ever possible, right? So that's the biggest advantage of raising or taking money through shares rather than debt instruments. Both equities and debt have claim on the liquidation value of a company should it become bankrupt or otherwise insolvent. So liquidation, in the moment when the company is in a bad situation, so the company will be getting liquidated. In situations like that, both debt instruments as well as equity instrument have some sort of claims. However, debt and liens must be paid first before shareholders are eligible for any monies. So debt people are always given, an advantage when the company is getting liquidated, because you are basically liable to pay for the people from whom you have taken loan, right? But share, when you've raised capital using shares, it is not a liability. But when you're raising money on a debt or borrowing money from someone, in that situation it is a debt. Okay. Investors buy and sell stocks on formal exchanges or over the counter. The former has a centralized trading and clearing operation, while the latter depends on dealers trading from their own inventories. However, from a technical analysis point of view, it does not matter where or how a stock trades if certain key information. So when I'm talking about key information, we've discussed this multiple times. It's going to be price as well as volume. So whenever price and volume is there, it is very, it is possible to do the technical analysis. That does not mean trading in each type of venue is identical. There is subtle differences perhaps in transparency and liquidity. So this is my chart of Tesla. Look at this. This is a candlestick chart. and these are my price, this is my price chart, and this is my volume chart. So you already know how to analyze the volume. In case again if you don't know how to do it, check the other videos in the playlist. Now what are the benefits to the investors? What benefits do investors receive when they are investing in equities of companies? Investors own stocks for three reasons. The first thing is capital gains. Obviously, the biggest reason why people trade in stock or invest in stocks is because of the capital gains. What is capital gains? I invested 10,000. Tomorrow, when after 3 years, my money is now 20,000. Just an example. So that is the 10,000 additional which I've earned is my capital gains. So that is the first reason why people invest. Second thing, over time it is expected that companies grow and stocks increase in value. So that is capital gains, which I have explained. The second reason is basically income. Now what is income? So the shares, the companies which raise money through shares, they divide dividends, they distribute dividends. So they distribute dividends to the shareholders. Dividends is basically a part of the profit. So if I have so many shares in different companies, then I am also earning money through the dividends, right? So that is also one form of earning money, right? A source of income. So this is my second reason. The third reason is to have a voice in the management of a company. So we can have voting rights, which means that if you have ever invested in any stock, you must have received the mail of voting rights, wherein there is an AGM and stuff like that, where you can basically take a part in the management of a company. You can assist the company in its decision making. This is the third thing. So these are the three benefits for investors. Companies have other methods to return value to shareholders. They may choose to buy back some of their own shares. The reduction in the supply of shares is basically going to increase the values of the remaining shares, obviously. Companies may also choose to issue special dividend payments to shareholders. So dividends is a form of income, we have discussed that. Moving on, other forms of equity. So until now we saw equity, we saw what a stock is and what are bonds. Even though it's not discussed here, we'll discuss it in the next chapter. Bonds are basically instruments by the government, okay? So they're not private usually. It is something which is related to the government. It's not private institution, okay? So now let's see another type of instrument, which is warrants. So warrants are other form of equity. Warrants are usually issued with stock and give the holder the right to buy more shares of stock at a certain price at a certain date. Again, warrants are issued with stock. So when you are purchasing a stock, they give you a warrant. So that warrant is basically a right for you to buy more shares of the stock at a particular price in the future date. If you can recall from the options chapter, we have already discussed what warrants are. Warrants are a type of options, but the price of it is determined by the company and not by the market forces. The major difference between options and warrants is how they are created. Warrants are issued by companies, options are written by other traders. Warrants have a longer maturity, and when an option is exercised, one trader delivers existing shares to other, but when a warrant is exercised, the company is issuing new shares. So this is obviously going to increase the shares which are outstanding. So that is the difference between warrants and options. Okay. So now let's discuss what is preferred stock. So what is preferred stock? When you have heard about the, like preference shares and stuff like that, you might have always heard about preferred stock. So what is preferred stock? Preferred shares are usually pay a higher dividend than common stock. Their dividends must be paid before common stock dividends. So preferred stocks, if you can read the name, you can see that this is basically preference shares only, but they have given it another name, which is preferred stock. So these guys are given preference before the other common stock. So the preferred stock holders are given more of preference. Even when the company is getting liquidated, the preferred stock people are paid before the common stock people are paid, and the dividends are also paid to the preferred stock people before they are paid to the common stock people. Okay, so even if a situation of bankruptcy or insolvency occurs, even in that situations the preferred stock people are given the more advantage. So there are several reasons why a company issues preferred stock, but the most important is that preferred shares give it the ability to raise large sums of money quickly. This is because institutions have special tax treatment and tend to buy larger blocks of preferred stock. So preferred stocks are obviously they have a huge amount of tax portion in it. So big institutions usually buy preferred stocks. Why? Because they have some tax incentives. Whereas individuals or retail investors like us, we don't do that. So in that situations, if you need a huge amount of money, so these institutions are ready to pay that. So the institutions basically purchase the preferred stock. Some preferred stock is convertible to shares of common stock under certain conditions. So now what is the downside of a preferred stock? So the downside is that it is callable, meaning the company can buy back the shares at face value under certain conditions. So if there is a situation wherein the company wants to buy back the shares, it has the option, the company has the option to buy back certain shares. Now let's come to convertible bonds. What are convertible bonds? Convertible bonds are debt instruments, firstly, okay, and for the most part they act like debt only, but under certain conditions the holder may convert or exchange the bonds for stock. They carry no voting rights until converted. So the convertible bonds do not have any voting rights as well. Okay, so they have a bond, right? They are bonds, right? So they have a higher status in bankruptcy than any of the bonds, than any of the stocks. So investors might buy convertible bonds because they want to protect the principal on the downside, but they want to participate in the upsides as well. So convertible bonds are also issued by the companies because they want to reduce their borrowing cost. When they are issuing bonds, borrowing costs are automatically reduced, right? So that's why. And convertible bonds are basically debt securities. Keep that in your mind. Okay. Alright, what does a technical analyst need? A technical analyst needs price, open, high, low, close, whatever, volume, number of shares which are changing hands, bid or ask, current prices buyers are willing to pay, that is bidding, and the sellers are willing to accept, so they are asking. So those are the things. Size, the limit or to the number of shares the maker of the bid or offer will trade. Time, what time did the trade take place? 52-week high and low. So 52-week high and low is the highest and lowest prices traded over the past year. Then we have market capitalization, which is the value of all the publicly available shares in a company. So whatever value of the available shares is, that multiplied by the multiplied by the price, right? The outstanding shares multiplied by the price will give you your market capitalization. So these are the things which are essential for a technical analyst. Now let's look at this. What are corporate actions? So the company takes some corporate actions, and those actions might have an impact on the price of the security as well. So let's see what are the different types of things that may happen. The first thing is ex-dividend. Ex-dividend refers to the date that determines who is entitled to the dividend payment. Investors purchasing the stock on or after that date are not entitled to the upcoming dividend payment. So it's always dependent on the date when the investor has purchased the stock. So that will only show you whether the person is eligible to receive the dividend or not. They literally buy the stock without the dividend. Buyers of the stock before the ex-dividend date are entitled to upcoming dividend payment even if they sell the shares before the dividend is actually paid. So that is my ex-dividend. Now we come to the next terminology, which is splits. Now what is splits? A company may split its shares for a number of reasons, but it only changes the number of shares outstanding. So the shares are split, but there is not really much of a change, right? So it only changes the number of shares outstanding. The value of shares remains the same as the price also adjusts. So the value is going to remain the same because eventually the price is going to adjust if you're splitting the share, right? For example, a stock trading at 90 euros splits 3 for 1. The result is 3 times as many shares trading at 30 euros per share. Okay? So this change then propagates back in time. So just read this. This is what is known as split, wherein you are splitting the value of a share into different parts. Preferably, usually it is done into 3 parts. What are reverse splits? Reverse splits create higher price for a stock with lower volume. Again, the value remains the same. This usually occurs when a stock falls below a threshold price. So reverse split basically is creating higher price for a stock with lower volume. So this is just joining the splits, right? This is the other way around. So that is my reverse split. Secondary offering. We all must have heard about the word IPO, which is initial public offering. That's when a company, it gives its debut in the stock market. So when the company creates a public IPO, is basically it's creating a public company for the first time. And a secondary offering is the issuance of new shares in an existing company. So that is the second time you are issuing new shares. So that is my secondary offering. This necessarily dilutes the value of previously existing shares. Companies do this to raise more capital rather than issuing debt. So instead of debt, they'll be raising more money through share capital again. So that is my secondary offering. The last concept is restricted shares. In a new or startup companies, insiders such as directors and key employees may be rewarded with shares of stock when the company goes public. So that's what they say when they use the term promoter shares. So promoter shares or restricted shares are those shares which are reserved for the company itself. So they are not traded in the markets, they are kept with the company itself for a lockup period. When that period ends, the potential for a surge in selling by these insiders increases, right? So that is the restricted shares. Restricted shares is basically when a company keeps some of the shares for the employees of the company itself. So those shares which are not publicly available for trading purposes, those shares are known as restricted shares. The last concept in this chapter is segmenting the market for analysis. So the markets can be segmented using various criteria, and they can be divided on the basis of various types of bifurcations. The first thing is it can be the equities in the market can be divided into sectors and industries. Like for banks, you can have a sector, for oil drillers, for healthcare, for gold miners. So according to the industry the stock belongs to, according to the industry the equity belongs to, you can bifurcate them and put them in those groups. That is the first way of bifurcating the equities. The second thing is based on capitalization. Capitalization is basically the market capitalization. If you go on the NSE website, you can see the market cap of the stocks. So on the basis of the market cap, you can bifurcate the equities into either large cap companies, medium cap companies, or small cap companies, or micro small cap. Or we can also bifurcate them on the basis of geography. So which country is it in? So for example, emerging Africa, S&P 500, KOSPI, DAX, Pan-European, Nifty 50. So all these indices are of different geographical areas of different countries. So that is again another way of dividing. And then other could be on any other basis like defensive, aggressive, growth and value. It can be on any other basis. So that's it with my chapter equities. I hope you understood this chapter. In the next video we'll be starting with indexes.